All right, good morning, everybody. I'm Roseanne Bump. I'm Executive Director with FEI Twin Cities. It's great to see everybody here this morning. You are at the 8th Annual Capital Markets and M&A Update Series. This is the first session, and we're going to be talking about SPAC with a session titled Let's Talk SPAC. This is CPE eligible. It is worth 1.5 CPEs. To be eligible, you need to answer at least 5 of the polling questions and be on for a total viewing time of at least 75 minutes. CPE will be available 7 to 10 business days after the webinar, and we are unable to grant CPE in cases where technical difficulties preclude eligibility. Before I get into today's session, I'm going to talk briefly about our upcoming events. This is the first of a 4-part series. So this coming Wednesday, we have a session on capital markets and M&A updates. Next Monday, we have Beyond the Numbers in M&A transactions, culture and people. And then a week from Wednesday, we have recent developments in reps and warranties, insurance and other transactional considerations. For those looking for CPEs in business ethics, we do have a session coming up on June 2nd. It is 2 CPE. So we hope you'll join us for that. And we hope everybody will come to our golf outing on June 21st at North Oaks Golf Club. And then we just added this as well. So our Twin Cities annual meeting will be on July 14th from noon to 1. It's going to be virtual, so we hope you'll join us for that as well. I'm now going to turn it over to Jay Trumbauer. Jay is COO and CFO of Belay, and he's also the chair of our M&A professional development session. So Jay, take it away.
Thanks, Roseanne. Well, it's great to be together. If you recall, last year at this time, we had scheduled this event and we had to cancel the event. So it's glad to be back, at least online. I'm looking forward to seeing everybody in person as well. And we are actually pleased to bring you a 4-part series right now. But in the fall, we are planning to eventually get back together again. And I am confident we can put together a deal maker panel like we had planned last year. And that's always an exciting panel for us to really get a pulse on what's happening in the market and hear some real live experiences. So I'd like a special thanks here to Roseanne and Joe Hausman for helping me with the whole event. It's been great, wonderful, and look forward to a nice 4-day series here. Without further ado, I'd like to pass it on to Mike McKee of Baker Tilly and the Baker Tilly team. Thank you.
Thanks, Jay. Thanks, Roseanne. Roseanne, first off, thanks for scheduling the golf tournament on the 21st of June. My son's birthday is June 20th. So anyway, I wanted to fit both in. So thanks for doing that. Perfect timing. Hi, everybody. I'm Mike McKee, and I'm co-presenting with Mallory Thomas today. We're both partners at Baker Tilly in the Minneapolis office. We both work with a lot of public companies and have worked in over our whole career with public companies. We're thrilled to talk about SPACs today. It's a pretty hot topic. It's been a hot topic for like the last 6 months. So we're excited to talk to you about that today. I know several of you are, finance executives at maybe public companies, private companies that might be thinking about going public. So, we welcome any questions you have. I'm an audit partner and Mallory's a risk advisory partner. So we kind of come at the public company kind of characteristics from 2 different angles. But, we'll tag team to answer all your questions today, but to the best of our ability. I think we planted a couple softballs with Joe and Jay, so they'll lob a couple to us if nobody has any easy questions, but we welcome some hard questions too, so let us know. Yeah, we'll go through a couple of US IPO considerations first, and then give a SPAC overview since that's kind of the hot topic, and then Mallory's going to finish with IPO readiness. Should we just start with a polling question?
Yeah, the polling question.
Well, then I think we have to fit 6 polling questions in during the day. So,
correct.
Have you or your company been involved in a SPAC transaction? A, yes, B, no, or C, what is a SPAC?
Thanks, Mike. That is now up on your.
I didn't know if I was supposed to read those or not.
I appreciate it. You cued me to do it, so that's perfect. So we will give everybody another second or so to do that, and then I will share the results, and then Mike and Mallory, you guys can share those back. All right, there you go.
Awesome, thanks. So I was one of the few people who answered yes, but I've been involved in SPACs more from an auditor standpoint, never from the kind of the CFO standpoint. So if any of you on the phone or on the call today have been involved in SPACs and want to chime in with a few comments or questions, we definitely welcome that. First off, for those of you who have worked for public companies, if you're entertaining a SPAC transaction, I think I would entertain, considering first if you want to be a public company or not. And Mallory, if you want to go to the next slide. There are definitely pros and cons to being a public company. Kind of on the pro side, you have a flexibility to trade your shares with high liquidity and daily valuation. You get more notoriety. You're in the news a lot more. You can use your shares as currency or consideration in an M&A transaction. When you're trying to hire and attract good employees, oftentimes employees will feel that your company is just more solid and feel more confident joining a public company versus a private company. There are definitely a lot of pros, but there are also cons. For those of you who worked at public companies, there's pressure to deliver quarterly results. You're constantly having to worry if you're disclosing, kind of competitive information about your company that your competitors can use to their advantage. It's not cheap. It's definitely expensive. The audit firms, the lawyers, any type of kind of compliance activity that you have to go through, which is definitely increased when you're a public company, gets expensive from time to time. So there are definitely pros and cons. I would say that, the companies I've worked with who have done IPOs have had to increase the size of their finance team significantly just to be able to handle the kind of increased compliance tasks that go along with being a public company. So I would definitely talk to your advisors on how you might be able to build out your finance team in order to get ready. And that's the topic that I'm going to save for Mallory. That'll happen kind of toward the end of the presentation today. Next slide, Mallory. So, and then a couple of just IPO success factors. This slide is written more in a general kind of IPO context, not a SPAC. But of course, strong management team is at the top. Without a strong management team with the experience to take the company public, it's pretty challenging. I've talked to CFOs who feel like number 6 is super important, the analyst coverage. When they're interviewing investment bankers to help with more of a traditional IPO, oftentimes they want to talk to the analysts because, once you get the IPO transaction out of the way, then, the analysts are the one who cover your stock and, are the ones who are going to be reporting to the public, a lot of information and news about the company. So CFOs I've talked to have felt like analyst coverage is extremely important. Mallory, go to the next slide. All right, so second polling question, what is a SPAC?
Thank you.
My kids are 24, 20, and 14. The 14-year-old doesn't worry about this, but I always hear about the new dating apps from the 20 and 24-year-olds. So they gave me that idea.
So what is a SPAC? Merger vehicle to IPO? I'd order it with a latte. Didn't it win an Oscar or a new dating app? So I see most of you have answered. I'm going to give everybody just one more second, and then we are going to go ahead and end the poll. And Mike, if you can share the results, that would be really helpful.
Looks like 90% of you got the answer right. 5% didn't get their latte this morning, so they're still thirsty. Okay, so here's our topic du jour today to talk about SPACs. And I'm not sure how many of you are familiar with these, but really a SPAC at its core it's called a special purpose acquisition company. And a SPAC is formed to initially raise money without knowing, you're raising money to acquire an operating company, but at the point where the SPAC is raising the money, they really don't know which operating company they're going to buy. When you look at the various SPACs that are out there right now, you could probably tell what their strategy is. For example, Omar, the old Medtronic CEO, he has a SPAC. So, you would think that his strategy is to look for medical device companies to acquire. That is always recommended when you're looking at SPACs to potentially invest in, that you look at the sponsors and the people behind the SPAC, that they actually have experience, with the industry that they're focusing on. But at its core, the SPAC really has no idea what company it's going to acquire when it raises the money, which seems a little counterintuitive, but that's just how SPACs are designed. They have a 2-year term. Typically, some have an 18-month term, but typically they have a 2-year term. And we've seen this before where, the first year, typically the management team is very focused on finding companies to acquire. Sometimes they'll acquire one company, sometimes multiple. It all depends on how much capital they've raised and if they can come to terms on, acquiring 1 or 2 companies. If the SPAC acquires 2 companies, obviously they would try to merge 2 companies in the same industry or 2 companies that have synergies with each other. We've seen that before where one of my SPACs that I worked with acquired 2 complementary companies, merged them together, and then they operated under one management team going forward. So that's also very common. If the pressure on the management team to execute a transaction is very high, the sponsor group initially lays out the capital to fund expenses of the SPAC, which is typically, maybe 3-4% of the deal. So they're putting that money at risk initially before they've even raised the SPAC capital. And then all the SPAC capital is raised, and the pressure that exists is that if the SPAC terms in 2 years, then all the investors can receive all their money back. But the SPAC sponsor who invested 3 to 4% of the deal doesn't get their money back because they've spent the 3 to 4% on marketing the SPAC. So there is pressure to get the deal done. Also, I always try to look at the incentives that are driving these transactions, and the SPAC sponsor probably has the most to gain, just because when we can get into the de-SPACing transaction a little bit later, but when they de-SPAC, the sponsor typically gets 20% of the deal or 20% of the stock, plus the initial stock that they acquired to fund the expenses. So sometimes they end up with 25% of the stock upon de-SPACing or at the end of the transaction, which is pretty big incentive to get the deal done. Typically the SPAC sponsor raises money during the IPO at $10 a share. And I think that's just sort of a historical tradition. I don't know the exact history on how they landed on 10, but even with the hot SPAC market these days, that tradition is carried forward where SPACs are raising money at $10 a share. Why is this route increasingly more popular? I would say, if you're a retail investor investing in SPACs, it's become more popular because of access, right? It's for a normal retail investor, people like you and me, it's almost impossible to invest in an IPO, a more traditional IPO, where anybody from the retail standpoint can invest in a SPAC. Also with, everyone's probably been reading about Robinhood and all of the trading platforms out there and how, the retail investor craze has increased immensely. So it gives, a normal day-to-day person the ability to invest in IPOs that really didn't exist before. And if you're a seller, if you're an operating company, it really gives you more predictable valuation to get acquired by a SPAC. If you think about it, if you're going down the more traditional IPO path, you don't know what valuation you're going to get when you IPO, right? You have to go through the whole process with the SEC. You're working with the investment bankers. They give you probably a feel for what your valuation is going to be. But until you go on the roadshow and exit the roadshow, you don't really know what the valuation is going to be. So with the SPAC transaction, you're getting acquired. So you have a little more certainty around that kind of negotiation outcome. The challenges, I would say the primary challenges are kind of needing to get ready to operate like a public company. Even personally, I receive, probably a call about every other week from an operating company who's entertaining getting acquired by a SPAC. And the first thing out of their mouth is, Mike, how fast can you get a PCOB audit done for me? Because they've either not been audited before, or they've only had an AICPA or a private company audit, and they just need to get a PCOB audit done as quickly as they can. So that's kind of one gating item for a lot of these companies who haven't been audited before, is just getting that done. And the audit always involves at least 2 years. Sometimes, it will take 8 to 12 weeks to get that audit done, and there's just a lot of pressure to get that done. Also, typically, sometimes these companies have maybe a CFO, maybe just a controller, and really not much help. So I even had one opportunity. It was a life science company, and the CEO and the controller called me, and then the controller called me right back after the CEO hung up and said, Mike, we have no business doing this SPAC deal. There's no way we're going to be ready. I couldn't believe that he actually did that, but I think he was just being honest with me. So anyway, but getting your team ready to become public is, probably one of the more difficult challenges. Also, I don't know if any of you read about the recent SEC scrutiny over several matters related to SPACs. We're going to get into more detail on the numbers, but historically, the level of SPAC activity ranged from 1 to 20 per year. So the level of activity was just very low, just due to the fact that interest rates are low, and IPOs have kind of gone crazy, and all of the kind of the kind of reason that the SPACs are popular these days. Since all that's been happening, the number of SPAC deals have increased immensely. So, whenever that happens and things get a little frothy, of course, the SEC steps in and tries to do their job. So there's been SEC scrutiny about certain factors related to SPAC deals. Those, that scrutiny has typically been about lack of proper disclosure around the conflicts of interest of the management team, forward-looking statements, and then warrant accounting. So the warrant accounting issue is, warrant accounting is pretty complex in and of itself, but I think the SEC identified several instances where the warrants weren't being accounted for as liabilities. They were being accounted for as equity. So it just changes the look of the balance sheet immensely. Also, there was some question about, during a traditional IPO, you can't make false forward-looking statements without, incurring some liability. So there was some question about even a SPAC deal if the measure was different related to forward-looking statements. So the SEC came out and clarified that really they're viewing them as the same related to forward-looking statements. So what that means is, if the management team is making obnoxious, forecasts and saying that their revenues are going to increase, like a hockey stick going forward, there will be liability related to those forward-looking statements and forecasts, where I think there was some question about that historically. So that kind of gives you a little bit of a highlight about the regulatory scrutiny. There were also a couple of SPACs that went south. One famous one was the Nikola one, the electric truck. I think the chairman they even put out a video where the truck was actually rolling. It was rolling it down a hill, not actually propelling itself. And that was the commercial that they would put out to the investors, and then raise money off that. And then they found that was actually a fraudulent commercial. The truck didn't actually work. So the stock price, started at 10, went up to 90, and then now it's back around 10 again. So stories like that, I think, worry the SEC too, which kind of leads them to step in. Any questions on any of that so far? All right, I'll just go through the SPAC life cycle a little bit. I talked about this a little bit already. So at the beginning, the sponsors or the founders really are the ones who form the SPAC, hire attorneys, underwriters, et cetera. And then they go through an IPO of only the SPAC. This is before they actually have an operating company in mind. They'll raise, 200 to 400 million is kind of typically the size. and they issue common shares and warrants. And the warrants is typically the holders of the units actually have potentially a lot of upside when they buy the warrants that goes along with the common share that they're buying. The proceeds are put in a trust account, and then, like I said, if the SPAC has to unwind in 2 years, then that cash is provided back to the original shareholders. And I think that's one kind of potential, popularity about SPACs is some people feel like they're pretty low risk because you get your money back if it's not invested. Now, the contrary kind of point to that is your cash is tied up in a low interest bearing account. So if you're investing significant amount in SPACs and it doesn't get put back to work, then you really kind of lost out and you had some opportunity cost there. But as I said, the SPAC goes through a process of identifying potential SPAC targets. One deal I was working on, this life science company, a different one, said that they were one of 10, pharma companies who were being targeted by the SPAC, and they didn't know if they were going to win out on the transaction or not. So, I think it's just it's sort of a matching up exercise, so that just like any merger, so that SPAC can identify which target it actually wants to merge with eventually. And then next is the de-SPACing. So once the SPAC has identified the target to acquire, that's when they file a proxy, go through the kind of de-SPACing. The de-SPACing is basically when they acquire the company ultimately. This process, although they fit this within the 2-year window, it's typically faster than a traditional IPO because you don't have to worry about kind of the back and forth with the SEC as you go through the SEC comment letter process. In my experience, though, the SEC does review that Super 8K, and typically we receive comments back. In my experience, it's been a quicker process than reviewing S1s. I think the SEC worries a bit more about S1s because you're doing a stock offering, where this is more of a transaction between two parties. I think that's it on that one, Mallory, if you want to move on.
Yeah, we just got a couple of questions that came in, Mike, so I'll just read these off. So first, what percentage of the capital raise will be put in by the founders?
It's typically not a large amount. Like I said, it's kind of 3 to 4% of the deal.
Okay.
And that's kind of an important point is, the sponsors, while they have the most to gain from these deals, that's why you see kind of these celebrities piling into SPACs, Shaq or Sierra or, whatnot, because they know they've been told that you can make a lot of money as the sponsor of these deals. It doesn't go without risk because you're providing the initial capital to fund the expenses, right? Because when you're doing the IPO, you have to pay for the legal costs and all that.
Yeah.
But you stand to gain a lot because you get 20 to 25% of the deal at the end.
Okay. One other question. So, since investors may not know what company will be purchased, are they pretty much just investing in the management team?
Practically, yes. And whenever you read anything about SPACs, that's always the advice, right? Don't just invest in a SPAC because Shaq is the one promoting it. What does Shaq know about life science deals, right? Probably not a lot. So, but again, if you have a proven management team, again, the founder or the latest CEO of Medtronic, he's a proven CEO of a huge medical device company, right? He has a good track record, probably a safer bet to invest in his SPAC versus Shaq's SPAC. I don't know much about Shaq's SPAC, so don't quote me on that.
All right, we've got a few more questions, Mike. Things are heating up here. So do investors get their investment back once the deal closes, even if the price goes from $50 to $10 as an example during several months prior to close?
I believe you do. I believe that you can get, I believe even if you do vote for the merger, I think you can only get the money back pre-merger. Once the merger occurs, then your ability to get your investment back has gone. Yeah, but you can vote for the merger and then still redeem your cash. So does that answer the question?
Yeah, I think so. What happens to funds raised from investors that are not used to purchase companies? Is excess cash returned to investors?
Well, so no, I mean, okay, so I think what you're saying is, say you raise 200 million in a SPAC and you buy a company for 100 million,
Yep.
right? Then what happens to the extra cash? No, it stays in the SPAC.
Mhm.
The sellers get 100 million, right? But then the SPAC is nicely capitalized, right? You have some excess cash, is what that means.
Yep. This one's kind of
the cash only goes away if somebody redeems their initial share.
So.
Yep.
This one's a little specific, so I'm not sure if you know exactly, but what is the rate of return / interest rate on funds in the trust if they are returned to the investor?
That's a good question. I don't know exactly, but I think it's fairly low.
Yeah.
Oh, you know what though? I think, Mallory, I wonder if this is a good time to pull up that SPAC Insider slide detail right now, because I think there's a slide on that.
Oh, is it? Okay, there we go.
Well, to answer the question, I think it's a fairly nominal rate, fairly nominal amount. Sorry, were there any more questions before we go through?
No, that's all. I think we got through all of them. One of them I think I'll address, so I think we're good so far.
Okay. So for those of you curious about kind of gaining more details, this is a fairly informative website, SPACinsider.com. And I like it, you know, as we scroll down, some of you may have seen this already, but you can tell, maybe Mallory, maybe just stay at the top. That graph, the red is the market cap weighted SPAC index. The blue is, you know, the S&P 500 index, just as a comparison. So you can see the run up. When was that? I think it was February 18th was when it peaked, which is when kind of the SPAC craze peaked, and then started plummeting. And now it's kind of trickled, you know, pretty far down. So, but Nikola, Virgin Galactic, right? The Richard Branson's, you know, space deal that went from 10 to 60 and is now down to 20, I think. So a lot of the SPAC stocks just, yeah, really went up like crazy and then really cooled down. And then if you scroll down a little bit, Mallory, you can gain an appreciation for the SPAC IPO transactions by year. So look, 2009, there was one SPAC, right? Now in 2021, this is updated daily in my experience. So we have 311 IPOs through May 3rd. So more capital has been raised in 2021 through May 3rd than in all of 2020. And if you look at the capital raised even back in 2014, it was 1.7 billion versus 100 billion today.
Crazy.
Crazy number, right? Mm-hmm. So now if you think about it, you know, there's maybe close to 200 billion of proceeds that are looking for deals right now in SPACs. And I was reading that private equity dry powder is like 2 trillion globally. So if you put this in perspective, I mean, it's really not that big compared to like all the private equity dry powder out there. So people ask me like, okay, are we in a SPAC bubble right now, or were we in a bubble before? Well, okay, the bubble's probably already burst and it wasn't even that big of a deal, right? So if you put it in comparison to other bubbles, the financial crisis, you know, the internet bubble, you know, it just is sort of a blip. So were there any other questions, Mallory?
Nope, you answered.
I think
the one.
Roseanne said, "Why the increase?"
Yeah, the rise.
I think the increase is just kind of due to what I talked about before, just people wanting access to IPOs, and the rise in kind of the retail investor. Right, you have this whole the whole GameStop issue where you had the short squeeze, how all these retail investors are piling in. Right, I think it's that phenomena combined with low interest rates. Right, low interest rates makes it favorable to buy equities. So that's increasing all the IPO activity. Yeah, so I think that's kind of the combination of what's driving the numbers up. Everything I read is that SPACs are going to here to stay. That's probably why the SEC is jumping in to regulate a bit more, right? Because they sense that, this is probably will be around for a little while. And probably not just a flash in the pan. SPACs seem to be a method of, getting acquired or investing in an IPO that'll probably continue for a while. So, all right, next slide. This is just kind of more of the same, just highlighting that the amount of capital going to SPACs has just gone off the charts. So probably go to the next slide. And this data was extracted from that website that we just showed, so I think it's a little redundant. I wanted to cover, there's been a lot written about SPACs lately. So, we talked a little bit about the first one. These are a couple of Wall Street Journal articles. SPAC hot streak put on ice by regulatory warnings. We talked about the reasons for that. I think those are all good, right? It's good that the regulators are stepping in to control things. Things were going a little bit rogue. The amount of disclosure in all the SEC filings just wasn't what it should be. The fact that, you could make projections that weren't accurate and have no liability, that's ridiculous, right? So I think the regulators are stepping in and enforcing rules that really needed to be enforced. SPAC insiders, can make millions as investors take losses. This kind of gets back to the topic I was talking about the sponsor. And the sponsor takes some risks in the front end because it's covering all the expenses, but it also has kind of the most upside, right? The point of this article was that with some of these stocks that ran up fairly quickly and then dropped, the SPAC sponsors were still making millions, even though the other investors might have been taking losses. Now, there are several SPAC deals where all the investors have made money, not only the sponsors. So, I would say this article relates to not a small percentage, but definitely a subset of the larger group, if that makes sense.
Mike, one question. So let's say you're a target company or a private company and you're looking to do a SPAC. What types of things should you be looking for from like a negotiation perspective with a SPAC? What are some of the things that you would want to consider?
Oh, that's a good question. Well, I would view a SPAC as just another way to gain an exit, right? I mean, it's just another option. It's just another option. So, you can sell to a private equity fund. You could, go public on the normal route, traditional route. You could sell to a strategic, right? The SPAC is just another option. So some operating companies sell to a SPAC and then the management team exits, right? Yeah. And a new management team comes in. Sometimes you can roll over your equity in a SPAC deal. So you have equity in your current private company, you can roll over some equity into the SPAC. So then you have some skin in the game going forward if you want to stay on the management team. It's just all part of the negotiation. Some people just sell to a SPAC and exit because they want to retire, right?
Yep.
So you could just view it that way, right? Some owners of companies sell to a private equity fund and do the same thing, right? Sometimes they'll roll over their equity into a private equity fund and continue as the CEO or the CFO, and sometimes they don't. So I don't know. I hope that puts it in perspective to kind of compare it to some other options.
Absolutely.
So. All right, Roseanne, we're on to our question number 3.
Thank you. I did launch it. So is now the right time to invest in a SPAC? Yes, no, let me ask my kids, or I prefer Bitcoin.
My 20-year-old loves Bitcoin. He keeps telling me, Dad, you're missing out. You should just buy as much Bitcoin as you can.
Have you?
No.
Not yet. All right, I'm going to keep it open for 1 more minute. So if you've not had a chance to answer the poll, now is the time to do it. All right, I'm going to go ahead and close the poll. And Mike, if you can share the results. Oh, I see a couple people are squeaking in here. All right. All right, Mike, if you can share the results, that would be helpful.
All right, 52% of you think it's a good time to invest in a SPAC. Definitely better than mid-February. So
bullish group.
There's still some interest in Bitcoin though. You know, you still want over some fans there too.
That's right.
People thinking like your son.
Yeah, might be a future topic.
Yeah, right. There we go.
Well, I don't
All
know if any of you follow Warren Buffett, but he was making some interesting comments at his conference on Bitcoin, SPACs, all that stuff. So anyway, we can talk about that later if there are any questions on his opinions. So, okay,
Yeah.
Mallory, over to you.
All right, I'll take things over. So hi, everyone. I'm Mallory Thomas. Like Mike mentioned, I focus in the risk advisory space. So I'll be talking about some of the internal control, more governance considerations as you think about IPO readiness and a SPAC as a vehicle to go public. So this next slide here just really does a nice job of summarizing some of the points that Mike made and covered on just the approach to public offering and how you may want to think about a traditional IPO versus a SPAC. So overall, thinking about a valuation. So for a traditional IPO, the market really drives the valuation, whereas with a SPAC, the valuation is really negotiated between that SPAC sponsor and the sellers. The timing, so typically a traditional IPO takes more time, whereas a SPAC is a much faster process. There's some pros and cons to the expedited timeline with a SPAC, and we'll talk through some of that in the future slides. Expense of going public. So Mike discussed some of these considerations too. While there's no underwriting discounts, the SPAC sponsor owns 20% of the stock. Proceeds, traditional IPO, you can raise equity capital. In a SPAC, you can raise capital, or you can use SPAC capital to repay debt or fund operations. And then the process, it's similar, just the timelines are more condensed for a SPAC versus a traditional IPO. The execution piece, so the market, like Mike mentioned, really drives the ability for traditional IPO. A SPAC really depends on the SPAC stockholders' approval of the business combination and target company, and acceptance by public stockholders as well. All right, so I'm going to get into my space of internal control considerations. And so we'll talk through some of the internal control things to think about. This includes some of the considerations as filing status, and then some overall just compliance considerations as you think about an IPO or a SPAC. So, and most important here is just an EGC. So an emerging growth company filing status helps take advantage of various reporting requirements, and auditors can rely on the ICFR requirements of Sarbanes-Oxley 404B. One point that's very important here is most SPACs are emerging growth companies. And typically, once they identify a target and they merge with business combination, there's some considerations as you think about your EGC status, if that's still applicable as a new combined company. Ceasing to be an EGC status, so some of these triggers are important to be aware of. So these are your more than 1.07 billion in annual revenue, your market value of common stocks not closely held exceeds 700 million, and you issue more than 1 billion in non-convertible debt over a 3-year period. These are the different things that would trigger, and you wouldn't be part of the EGC status. And EGC status provides a lot of different opportunities, a lot less compliance, and even reporting requirements as well. As long as the merged company meets the EGC status requirements, you don't have to have the auditors report on internal controls over financial reporting. So that's your Sarbanes-Oxley 404B. And that can continue up to 5 years as a part of that EGC filing status. Management may consider not reporting on internal controls for the acquired business when assessing ICFR internal controls over financial reporting under Section 404A of stocks for that first year of the 10K following the business combination. So you get a kind of a year of relief. Management may use this exclusion regardless of your filing status, if your combined entity is an EGC or not an EGC from a status perspective. And it's really important in a lot of these decisions that management applies judgment, whether it's possible to complete an effective assessment of your target's internal control environment, just really due to the timing considerations. Like Mike mentioned, these SPAC acquisitions and deals tend to be real quick. And there's a lot of work to do, obviously, on the financial accounting piece, putting together your financial statements, SEC reporting, and obviously the internal control considerations too. Companies do have to comply with the Section 404A, beginning with the company's second annual report following its public company offering. So that's an important consideration. You do have to have 404A compliance, and I'll go over kind of what that means from a management perspective. So this slide does just a really nice job, I think, of summarizing the filing status as you're thinking about IPO, the size of your organization, and what that might look like. As I mentioned here, this goes into your requirements for compliance with Sarbanes-Oxley 404B, and if you need to comply based on your filing status. The public float, this is typically kind of the trigger that we see. It kind of sneaks up on some companies when you do an evaluation of your public float, and that can really trigger that to lose your EGC status. We've seen that with quite a few different businesses where it creeps up on them, and then they saw it and they had to start complying with 404B. So that's something just to consider from an overall IPO and growth perspective within your company. So the SPAC merger timeline, I think this slide just does a good job of talking through the different activities that you need to be thinking about as you're looking to go public through a SPAC or a traditional IPO. So with the pre-target SPAC negotiations, so here we've outlined the activities a target company should be thinking about when evaluating each phase. So can you prepare financial statements? And Mike talked about just the PCAOB audit and making sure that you're auditable. And that's a very important piece, is making sure you can pull together those financial statements in accordance with GAAP and SEC, and that they are auditable. And a lot of times we see organizations, they can pull together their financials, but making sure they have all of the support to back up any estimates or judgments that they're utilizing within their financial statements as well. Sometimes enhancing some of those memos and just considerations that you're taking is very important. So your close process is another area that we see. Lots of times you're not used to, as a private company, having to close so quickly to meet SEC filing deadlines. You may not even do a monthly close, maybe just more of a quarterly process, making sure you have the bandwidth and the resources to assist with the close and gathering the information to put together your financial statements. One of the areas that we see from a control design perspective is really segregation of duties. So lots of times in a private organization, you may be trying to implement good control environments and you have second level reviews. In a public company, that becomes more and more important, that you have segregation of duties, someone different performing the control and executing the control and reviewing the control as well. And then information systems. So lots of times, this is where we see a lot of transformation. So as a private company looks to go public, do they have that infrastructure? And that infrastructure is people, process, and technology. Do you have the people to support that? Do you have the processes in place to really scale your business? And then do you have the technology? So lots of times the technology piece comes down to ERP systems, payroll processing systems, budgeting tools, even your close and reconciliation processes. We see a lot of companies utilizing applications and software to assist with this. So as you think about doing your financials in Excel, making sure that you have a robust tool later on to support that. Lots of times we hear the, Uber and QuickBooks, going public. Yep, you can do it, but is it scalable in the future? And knowing that there's just so many different projects you're going to take on as you go through the journey of being a public company on that roadmap to being public, it's important to kind of tackle these piece by piece and making sure that you just have that infrastructure in place to support being a public company in the future. And then governance. So an important consideration here is, and this is something that we've seen as a target company, some of the negotiation processes, your outside board directors need to identify people who's going to be on your board. What does that look like? What does the management roles look like? Like Mike mentioned, those are something to consider as a part of the negotiations with the SPAC sponsor and the target company, and making those agreements in alignment of what that future management team looks like, who sits on the board, making sure you're identifying those outside directors that you would want to be on your board as well. You have to have a financial expert, and so that's a key area of finding people with that talent and skill set as a part of your composition of your board of directors. Then we move to just some of those transaction activities. So here's how we get the nice piece of being an EGC. You only have to have 2 years of historical financial statements versus 3 years of historical financial statements. Here it's really putting together those interim financial statements, your port forma, your MD&A and your market disclosures, SEC comment letter responses. There's a lot of work that goes into the transaction activities. And this is where we see a lot of companies just needing some support. because they might not have the talent or the bandwidth in-house to execute a lot of these different phases of work. And then post-transaction, when you're a public company, thinking about just the overall SEC reporting process, your 302 CEO and CFO certifications. I'll talk about those in a little bit. This has become kind of a highlight of the SEC recently around disclosure control procedures. ICFR, so your SOX 404A or B, depending on the filer status, any listing standards or requirements that they may have as well. And then just your overall, some of the public company obligations. So having an annual meeting, your proxy, all those things that go into being a public company. All right. So we have polling question number 4.
Perfect. Thank you, Mallory.
Would you prefer a traditional IPO or a SPAC merger? SPAC, traditional IPO, neither. I'm just here answering CP.
All right, we have about half have taken the poll. I'll leave it open for another minute or so.
I have a question for you, Mallory, once this is over too.
Oh, good.
Or do you
All
want
right,
to ask it, Jay?
No, go ahead,
Sorry,
Mike.
Roseanne.
That's okay. I'm going to go ahead and close the poll. And then I will share the results. And if Mallory, if you can just comment on those.
Yeah, so would you prefer, so most people said a SPAC. I'm guessing that's because it's quicker, faster, and more appealing at this point. I hear you, I'm answering for CP in a lot of these too. Traditional IPO, 24%, and neither. You want to just stay a private company. I get it too. All right. Mike,
Do you want me to ask you the question, Mallory?
go for
So
it.
Jay has a question. Okay, for the group, if a company has only done a review in the past and no audit, does it take a company the same amount of time to become IPO ready compared to SPAC ready?
Well, I mean, it's just a condensed timeline. So you have to get there faster typically. And so I think what we've seen with clients is it's just quicker just because of the deal and the transaction. You know, in typical IPO, you have more time to kind of lay the ground and get things going versus a SPAC, you just go much more quickly and the timelines are much more condensed. Would you agree, Mike?
And either way, you have to get a PCAOB audit done.
Yeah.
Right.
It doesn't matter.
So if you're going from a Jay, good question, Jay. If you're going from a review to a PCAOB audit, that's a significant upgrade.
Mm-hmm.
A lot more accounting memos to be written and signed off on by your auditor. So.
Yep. Absolutely. All right. So now I'm going to talk about some IPO readiness, and I know I kind of spoke to this on the previous slide, but we'll talk about this from just a holistic perspective. So lots of times, and Mike said, we have, target companies that are looking to go public via SPAC, call us and say, hey, we're thinking about this. What's this whole SPAC thing? Tell us about it. What do we need to know? And that's kind of where we start with the IPO readiness assessment. Understanding, is this right for your organization? Are the goals and objectives aligned with the strategy that you want to put in place? Sometimes that might not align correctly, and the timelines might be appropriate, just kind of given where you are from a maturity standpoint or where you are in the marketplace. And can you scale more and it may be more advantageous to go public later on? So, we kind of recommend this IPO readiness assessment as that first step, really understanding holistically your operations and the tasks and really that sequence timing to support the IPO readiness. This becomes even more important with a SPAC because it's such a condensed timeline, and helping organizations and companies to go public, you need to have that infrastructure and support because you likely don't have a large team. If you're a private company, it just didn't make sense before. Why would you have, this many people in accounting or financial reporting? You weren't doing those activities. So you're going to need some support to kind of get things up to speed as you go through that IPO process and that SPAC process. So depending really on the size of your organization, you may have some of the infrastructure to support a public company and those related requirements, but really in working with clients, we really find that first step is to understand the operations and needs of your company as you look to potentially go public. From there, you can develop that roadmap, prioritize those next steps and tasks to be completed in the process. With some organizations and companies, if they are large enough, they'll have just like a project management office to assist with the IPO and coordinate all of the different activities. So that's something to consider. Just kind of a point person from a project management perspective is a good place to start, because there's a lot of things to coordinate, especially if you're using outside resources and vendors, making sure that you have the right consultants and the right skill set, and the decisions are identified, and there's communication across kind of that stakeholder group too. The pre-transaction activities, once you've seriously determined that you are considering public markets, so yep, I want to go IPO, this makes sense for organization, it's the right thing for us, we highly recommend kind of evaluating your internal controls. This can be kind of that one of those first things to do as you get into the 302 certification, and I'll speak to that in a bit, your Sarbanes-Oxley compliance. This takes a lot of effort, especially if you're a private company where you haven't maybe even identified, you don't have an RCM, risk and control matrix, you don't have narratives kind of describing your processes. You may have a lot of gaps within your internal control environment from a segregation of duties perspective, which all made sense as a private company, but as a public company, those things need to be shored up, and you need to kind of implement that control environment. And this really includes scoping and understanding your IT ecosystem as well. I spoke to your ERP and making sure that you have the technology that's scalable with you. So thinking about your ERP system, obviously any payroll systems that you utilize, any CRM tools that you utilize as well that may trigger some revenue recognition. Those would be in-scope applications. So understanding the different controls around those IT systems is important too. Then there's many tasks to complete related to technical accounting. So public companies have different timelines than private companies when it comes to accounting standard adoption. So it's important to evaluate what you need to comply with. Some of those timelines may be accelerated because you were kind of working towards the private company timelines, and now you have to look to the public company timelines. And then just some of those memos and policies that really support the defined processes within your business, documenting those and really making sure that they're detailed enough to really describe the process that you go through and some of the evaluation and judgments that you make as a team. And then additional SEC matters are important too. So your S1 filing, then any subsequent SEC comments that need to be addressed, making sure that you just have the team to support you with all of this work. I know this seems like a lot, and it is a lot. It's a lot of work to get done, and making sure that you have those resources. You think about some of these smaller accounting teams, maybe a controller that's wearing, a CFO that's wearing a controller hat too. I mean, those are things that you just got to think about that transition, and what does your team look like to support all of these different activities that are ongoing through the IPO process. And then also after the IPO process and you're a public company, a lot of these activities continue throughout. So ongoing with the internal controls, identifying your controls, you need new systems to support your environment, documenting your controls and addressing any control gaps that you have, developing an ethics and business conduct policy, as well as a whistleblower hotline to support public company requirements. Another important item to note is the 302 certification process, and this is for disclosure controls and procedures and personal accountability of the signing officers. So companies are required for initial public company filing to be in compliance with sections 302 and 906. And that requires that the CEO and the CFO of a public company certify that the company's financial statements are accurate and comply with the requirements of the 1934 Act, and that the information reported is fairly presented. So for this reason, we really recommend, like I mentioned before, spending some time on your internal controls, because if you're the CFO or the CEO that's signing, you want to have comfort that your financials are accurate, that you have some controls in place, and you feel right that the information is appropriate and doesn't omit any material information. So just something to think about. How do you give the CEO, the CFO of your organization that comfort when they're signing that those controls are in place? And lots of times we see this process get more and more developed as the company matures, and you have, sub control owners that are certifying, and then that kind of, rallies up to the CFO as well. So there's different ways to kind of incorporate the certification process, but it's something to consider early on. And a lot of this kind of bases that need for internal controls early in your process and early in your IPO consideration. So this last slide here, we talk about IPO readiness. And, lots of times they focus on the accounting and reporting processes, which is important. But really, it's holistic considerations as a company evaluates your IPO readiness. So we've discussed a lot of these areas on the previous slide, really focusing on the accounting and some of the governance issues as well. But assessing your company through a holistic lens will help you determine some of those gaps and understand maybe where you need to hire, or maybe identify outside assistants, consultants, or maybe where you just need to realign roles and responsibilities within your current organization. So this varies, based on your timeline. There may be some things you can do as you start to prepare for an IPO, but it's just helping you on the overall journey to an IPO and thinking about all these things from a readiness perspective. We've hit on a lot of the accounting and financial reporting pieces. And I think this is important to consider. Obviously, making sure that you can close books is important. You can do all the accounting policies and procedures. There's current training for your accounting staff, and just overall, you have financial reporting systems to support you. Internal control, I spoke to this a lot. So your financial and IT controls, your documentation, and any testing of controls that you need to complete. Here I'd also consider just making sure that you prioritize your RCM and identifying controls and really addressing any gaps within your control environment early on so that you're set up for success in future years. Taxes, there's a lot of considerations. Obviously, going from a private company to a public company, really evaluating those tax structure and all the different considerations as that evolution occurs as well. And then just your overall tax process and your filings, making sure that you have a good process in place for that. Human resources, this is something that's kind of overlooked sometimes, and a very important part of the overall evolution into a public company. Your existing HR team, understanding their roles and their expertise. Compensation is important, and executive compensation structured. So creating that holistically as you think about a public company, that becomes a very important task. Your HR people and systems, what does your payroll system look like? Are you going to outsource that? Or are you going to keep that in-house? And then additionally, I'll go back to the controls around those systems, making sure that those are adequate as well. And then existing policies and procedures. So lots of times we talk about the NC level controls within an organization. That really comes from the tone at the top. And HR plays a major role in this, making sure that you have employee handbooks in place, conduct policies, ethics policies as well. Really that infrastructure to support that culture of an organization kind of falls within the control environment too. Governance and compliance. So this is really just, thinking about your charters, bylaws, code of conduct, ethics, whistleblower hotlines are important to kind of start setting up. Risk management, you can think about that in a holistic manner. What are the risk management operations? Do you have enterprise risk management function? How do you evaluate risk within your organization? Investor relations is kind of a big duh, especially in this space. I mean, you're going to need to think about, do you hire someone in to help execute this work, or do you outsource that? Obviously, you're going to have a PR firm to assist with roadshows and execution of different processes from a marketing perspective too. Financial planning and budgeting. So here we think about existing planning, analysis, and budgeting process. One of the most important things is, Mike talks about the analyst coverage, and that's key in a lot of these IPOs, is making sure that you have analysts engaged and supporting your IPO. And a lot of that comes down to the roadshow. So being able to provide good financial forecasts for them to understand your assumptions, understand your story is really key. Being able to articulate and communicate what you plan to do and how you plan to get there. Treasury, so that's the debt and capital structure, thinking about capital raising and capital funding. Legal, obviously, this plays a huge role in your IPO process. SEC, legal counsel, even the IPO process as well. You need to seek some specialized legal counsel there as well. And then just thinking, lots of times we see in private companies, sometimes they don't have that role in-house. You may consider, bringing someone in-house to assist with some of those tasks too. And then lastly, information technology. I think this is key as you think about the transformation and scalability of your organization. So how do you automate some processes? How do you make sure things are adequate from an existing policy and procedure? Think about like access controls, who can get into your systems, making sure that those financial reports are accurate. You need some good provisioning. And then also just overall systems and applications. You may look to different applications to support different processes like reconciliations and such, but making sure that you have the right controls are over that ITGC, so the information technology general controls. You have good processes in place there from an overall management and governance perspective. Change management, cybersecurity, and data privacy. You know, if you're working internationally, those are very important considerations with GDPR as well. And then just your user roles and user access, making sure that the right people have access to the right things. An important consideration here too is just building your system so that you can have appropriate approvals, so you can automate some of your workflow. Someone executes it, someone approves, someone reviews, and making some of those enhancements to really scale and automate some of your processes. So we went through quite a bit of material, just overall kind of what it looks like to become a public company. Welcome any questions or thoughts or considerations that you guys are thinking about your plans, or maybe not plans to go public, but love to open it up for any questions.
You see that question, Mallory? I can ask it.
Yeah.
How easy is it to gain analyst coverage in an IPO or SPAC? I thought analysts like to focus more on established entities.
I mean, I think that's changing some too. I mean, I think just kind of given the marketplace and the increase in the IPO market and SPACs, there's been more coverage on these entities. I agree. Obviously, you know, when you're reporting to the street as a public company, analysts are very, very important because they're going to make a lot of those decisions and drive a lot. But from an initial public offering, I think we're seeing more and more of that coverage and just interest overall. And I think, you know, Mike talks about just the individual investors. I think there's much more interest in the stock market recently than there ever has been, and people are more engaged. And so I think it just creates more noise too within the marketplace.
Well, and I think once a company, you know, gets sold to a SPAC, investment banks, you know, there's always opportunity for follow-on offerings, right? So investment banks are going to want that company as a customer for follow-ons. So I think there's definitely incentive for the investment banks to try to get to know those companies after they've done a successful SPAC transaction, right?
Yeah,
and I don't know. Yeah, typically, you know, I see more analysts involved based on the size of the company and the industry. If it's a tiny company, typically they have a hard time getting analyst coverage, right? If it's a big, newly public company, they don't have any problem getting analyst coverage, typically.
Mike, you want to answer? So what's involved with a roadshow?
So, Roseanne, so you mean in more of a traditional IPO context, I think, right?
Yeah.
So that's where, you know, the bankers are taking the management team on the road to market the offering. So you've gone through the SEC comment letter process. Now you have your prospectus or final S1 that the SEC has blessed, right? And now the job of the bankers is to go out and sell the company stock on behalf of management. So it used to be that you jump on planes and fly around to all these cities, right? Go to Europe, go to London, go to New York. Now all the roadshows are virtual due to COVID. So, but you hear some crazy stories from the road from some of these. Maybe some of you on the call have been through that before, but I've not done it myself. But I've heard a lot of good stories. So.
All right. Well, we can move to the next polling question if that works. So, did you enjoy learning more about SPACs? Yes, no. I have so many more questions. No idea. I've been multitasking this entire session.
Thank you. All right. This is poll number 5. So for those of you looking for CPE, you need to answer at least 5 polls. I am going to launch another one immediately following this one, just in case you missed one along the way. So I'm going to give this just another second or two. We have most of the folks on the line have voted. Okay. All right, I'm going to end this and share it.
All right. Well, I'm glad no one is multitasking.
That's
I
right.
feel like that's such a go-to these days, let's be honest, in webinars. It's like, so yeah, it looks like everyone enjoyed learning more, and some people have some more questions. Which is great, too. And you can reach out to Mike and I if you want to chat more.
This is Minnesota. Everyone's nice.
Yes.
That's right. And I am going to launch that extra question for those that did not have the opportunity, or if you want to offer us feedback, that's always appreciated as well. So did this session meet your expectations? Yes or no? And we do have about 7 or 8 more minutes on this session available. So if there are additional questions, it would be great to continue for a couple minutes.
Roseanne, let me clarify one question. I don't know if I answered it thoroughly enough. So,
Okay,
Mallory, you asked if all the capital in the SPAC doesn't get put to work, kind of what happens to that, right?
Yeah.
So typically you need to have 80% of the capital in SPAC used to acquire companies. It can be one, it can be many. So you can't only invest, you can't only take the capital out of SPAC and buy one company for say 50% of the capital. That can't happen. So if that's the case where you 200 million in the SPAC and you found a company to buy for 100 million, you need to go find another company, either a bigger company with a higher valuation or another company to tack on, so you can buy 2 companies to spend at least 80% of the capital. So, but you can have 20% left as capital to retain within the entity after the de-SPACing exercise. So hopefully that's a little more clear.
That's helpful.
Hey, Mike, question. Does that 80% have to be spent in the 2-year period, or once they make an acquisition, does the 2-year period reset?
So I don't know, Jay. Whenever I've seen multiple acquisitions, they're usually done kind of simultaneously.
Okay.
Like I've never seen like where you go buy one and then you wait another year and then buy another. See what I mean? So what?
Yeah.
Maybe you can. I just haven't seen that before.
Well, it just puts pressure. I think it puts pressure on the sponsors and the team working to load up with prospects, right? As quickly as possible.
Right.
Because if they've got to get it done in a 2-year period, that's, can be kind of quick.
There's a lot of pressure on them to get those deals done. So
I'm kind of interested in your predictions of where SPACs go from here. Given the regulatory nature and the oversight is increasing, do you think people will be sitting on the sidelines from SPACs, or do you anticipate they'll just work through it and continue the vehicle?
I think in the short term, people are going to sit on the sidelines a little bit until this, the warrant thing clears up. A lot of SPACs are having to restate their financials due to the new warrant accounting or the clarified warrant accounting. So that'll take a little while to cycle through, maybe a month or two. They're not all, like Baker Tilly doesn't audit any SPACs. There are only a couple of firms who audit the vast majority of SPACs. So that's also one problem, is the fact that a handful of audit firms are auditing all the SPACs. They have to process all these restatements. So that's probably not very fun for them, but anyway, it's just a reality. The SEC came out and clarified. So long story short, I think there'll be a little quiet period here because there aren't any new SPACs starting as a result of this, right? And then you got to cycle through, also there's a lot of capital out there looking for deals now. So, does that capital need to be put to work before anyone else is willing to raise, more money or invest in new SPACs? It'll be interesting when you get a year or two out too, when those deadlines start, when you start hitting those deadlines. Mm-hmm. And if a lot of them haven't found partners yet, then what's going to happen, right? So they're just going to start needing to, because the sponsors don't want to give the money back, right? It's like a private equity fund getting money back. Like nobody wants to do that.
Good point.
So you might see the valuations tick up, right? Which, if you're a seller, that's good news for you. If you're a seller of a company, right, you can sell for more. So a couple of things to think about. That's why Warren Buffett said it's going to be hard for him to buy companies as long as the SPAC trend continues, because he's competing with private equity, SPACs, right? It's just hard to find. And, he likes to find deals on the buy side.
Right.
And Mike, are SPACs performing similar to traditional IPOs once they are launched? Price-wise?
Well, they were there for a couple months. I mean, even better, right? There was sort of a mania, SPAC mania there, but now things have come back down to earth, and now that kind of remains to be seen, right?
Okay.
I think the problem is that SPACs were buying like space companies, e-vehicle companies. It's like, these, even Elon Musk, I heard one of his interviews, and he said we're never going to take SpaceX public because the ROI timeline is way too long. Like you can't measure how they're doing quarter by quarter. It's impossible because they're trying to colonize Mars, right? Like that's going to take 20 years. So how can you take that company public? You can't. So anyway, that's one guy's opinion, but the space companies, like, I don't know, for some reason, the space companies just caught up in the whole SPAC media too. So yeah, tough to say. I think when you get more normal companies getting acquired by SPACs, then you'll kind of see a normalization of the trends upward, right? So, and you've seen some of that. We've seen life science companies who've done well with SPAC deals. You've seen normal tech companies, software companies who've done well with tech deals. Those deals are a little more kind of representative of kind of what a normal transaction would be. And those results are more normal, I would say, in comparison to traditional IPOs. The problem is you only hear the headlines, right? The headline is Nikola's truck doesn't work, went up to 90, went down to 10. That's what you hear about in the headlines. You don't hear about the small drug company who just did a pretty good deal, right?
I have a question on that too. So I'm intrigued by the roadshow. So is that for investors looking to get in to it? So that's public and anybody can be there? Or is that once you're an investor, you get the additional information? And how do you find those? Is that on that? Yeah, the roadshow. Is that on that SPAC Insider? How do you know these things are coming? How do you find out about them?
So sorry if I wasn't clear. The roadshow is more of a traditional IPO path, not
okay, got
SPAC.
it. Okay.
And that's where, so.
Okay. So is there a way to find out more about SPACs that are coming up and what it's about, or how do you know what you're investing in aside from the management team?
Mallory, I wonder if you want to go to that SPAC Insider website. So if you scroll down, what's that?
I just read your mind. I have it up.
Way to go. So if you scroll down, this website is pretty comprehensive. If you keep going down, it gives specific SPAC details. So like here's the annualized rate of return. This includes all SPACs that exist.
Wow.
So, the newer ones, there's really limited data, right, on the returns. And, these are ones that haven't invested in they haven't de-SPACed yet. They haven't bought a company yet. So they're trading at $10, right? Because there's really no reason to, and like you would say, Dragoneer Growth Opportunity Fund, it's up 2%. I don't know why. You'd have to go look at that. You'd have to go look at that ticker symbol to see why. Maybe there's some outstanding CEO who is on the sponsor team, and maybe people feel like it should trade above $10, but it's not. It's only trading 2% above $10, so nominally above. And Mallory, if you scroll down a little bit, there's more data on. So this is in chronological order. So now you're getting to SPACs that started more recently. Here's a universe of SPACs that have announced an acquisition. So CM Life Sciences 2, you go to Yahoo Finance or whatever and type in CM Life Sciences 2, you can see that they announced an acquisition and it's up 38%, right? So it's up 38% off the $10. There are a couple like Richard, if you scroll down, you can see like Richard Branson, Virgin Galactic, I think is at 100%. Well, yeah, it went from 10 to 60 down to 20. So it's still showing up 100%, but that's if you bought in at 10. If you bought in at 60, then you're down to 20. You're not feeling very good. So,
Perfect.
and then it gives averages at the bottom. So, which is kind of nice.
Hmm.
The median is, right around 7% up.
Thank you. Well,
I haven't audited this data, so I can't tell you it's actually really correct, but it seems to be the only data out there. So.
yeah.
Mike, was that a disclaimer?
Yeah.
That's right.
Coming from an auditor, right, Jay?
On that note, I do want to be respectful of everybody's time. We have hit the end of the session today. So Mike and Mallory, thank you so much. Appreciate your input. Thank you to Baker Tilly's input. Jay, any final comments before we move on? George is giving you a hand there. Thanks, George.
Well, we'll see you all at the next ones.
Great.
Thank you.
Thanks, Roseanne.
Thank you,
Thanks,
everybody.
Jay. Good to see everybody.
Great. I am going to leave the session open. So if
Cheers.
you feel like you need a few more minutes to get that CPE minimum, please just stick around. Everybody else can sign off. Thank you so much, everybody.
We must be close, Roseanne.
Yep, we're at 77 minutes, right? 77 minutes. So again, if people got just a little bit late start, actually, I'm going to hit Alt C.